Welcome, everybody. It's Gary Brown with TUG. I want to thank you for attending the Phocas webinar today. The presentation will be made by Jenny Kate and Jason from Phocas. Jenny Kate, it's all yours. Please take it away.
Great. Thank you, TUG, for hosting us today, and welcome everyone to today's webinar, Customer Profitability and Stratification for Infor Distribution Users. We really appreciate you making time in your busy day to review the Phocas data analytics solution and how it provides insight into your customer base, ultimately helping you increase profitability. My name is Jenny Kate, and I'm on the marketing team at Phocas. Over the next 45 minutes or so, I'll be your host, and soon I'll be passing it over to Jason Birch, one of our solutions consultants. So first, a few housekeeping items on my end. Our agenda today, we'd like to cover the benefits of using data analytics, how to gain a better understanding of your customers. Then we'll be showing you a demonstration of Phocas, specifically highlighting customer stratification and how that can lead to increased profitability in your business. Phocas is a data analytics solution designed for manufacturing, distribution, and retail companies. We have a pre-built solution for Infor users, making the implementation and user adoption a seamless process. But most importantly, we've learned to anticipate the needs and wants of Infor users like you, making our software relevant to your business. Our solution allows users to follow their train of thought and interrogate their data in a way that is quick, easy, and comprehensive. There are countless opportunities that can be uncovered, such as cross-selling, optimizing processes, and maximizing inventory. Also, using Phocas, you'll have the ability to monitor business performance over any period of time. The cost to serve customers has a direct impact on business success. With already tight margins, the cost to serve can easily tip the balance between profit and loss. What we'll be showing you today is customer stratification, which gives users a framework to quantify customers' behavior into groups: core, opportunistic, marginal, and service drains. Identifying customers whose behavior is not conducive to positive profitability allows for these at-risk situations to be addressed. Now I'll be passing it over to Jason Birch for a customer profitability demonstration.
Thank you. Just give me a second to share my screen out.
All right, we see it. Thank you.
Awesome. Thank you very much, Jenny. So just to echo what Jenny Kate said, I just want to say thanks to Gary and the guys. It's as Gary said, we've been doing this for 7 or 8 years now. We've had great success and great support from the team over there, and we really appreciate it. So what we're going to talk about today is the process that we've gone through over the last 20 years. Phocas has been working with manufacturers and distributors, working with lots of companies on Infor products and other ERPs. And what we've heard from all of them is that the analysis they do in Phocas is very useful to the business. It helps them get a better understanding of what's going on, where they're making profit, where they're holding too much inventory, and so on. But one of the elusive areas, which they're all interested in, every customer we work with has an interest in this, is how truly profitable am I? So the gross margin that I make from a customer is very interesting. But how much do I actually make once I've interacted with this customer, once they've come into my showroom and drunk all my coffee, or once they've sent back half of the products they ordered? How much have we actually made from interacting with this customer? And every customer that we've spoken to about this has an idea of what kind of drains on that profit margin there might be, but they don't have a definitive list. They don't have a definitive idea. So lots of our customers had asked us if we had anything that did that, if we had any idea, if we could essentially give them a framework to work around. And at the time when we were first asked, we didn't have that framework, but we decided it was time to do this. So about 1.5 years ago, we sat down and we pulled together actually some of our top customers, some of our most forward-thinking customers across different ERPs, across different industries, but all of them distributors of hard goods. And we sat down with each of them and said, we polled them essentially, and we worked with them to understand what is it that drives the cost to serve within your business? What is it that defines a good customer or a bad customer, a customer that's a service drain or one that's part of your core customer base that behaves the way you want? So what we did is we spent time working with those guys, and we got some industry insight as to what did and didn't drive cost to serve. What we then did is said, well, how much of that cost to serve, how much of that insight can we use and marry up with Phocas data? So data that's already flowing into a Phocas analysis database. So that may well be sales transactions. It may well be accounts receivable information. It might even be data that's being captured in a CRM tool, for example, about how many interactions you're having with a customer. All of that data will already be flowing into a Phocas data analysis environment. So we looked at marrying those two up. And what we did is we actually came up with a model that allowed you to take those drivers, that information, that idea of what's going on in a business. So, for example, if somebody sends back more than 10% of what they order from me, there's a cost to restocking. If there's X number of costs involved in placing an order. So if a customer places 10 orders with me a day, each with a single order line on it, that's the same cost as placing 10 orders with 20 order lines on each one. That's a cost to serve. So being able to marry those up, marry that insight with the data, and build a model that could then be applied to that data was what we did. So we went through that process. It took a few months. We worked with those customers, and we came up. So we actually started to run their data through it. So all that information flows into this data crunching engine. So a set of algorithms that then run. And what gets pushed out the other side, what comes out the other side, is actionable data. So it's essentially a look at each customer, the cost to serve broken down by the various areas where it costs you to interact with them, and then a true profitability. So that actionable data then can then be taken back into the business and used to try and change behavior, and try and change the way those customers work with you. Now that should result in, if you do it correctly, should result in business benefits. And those business benefits could be everything from increased profitability to better performance. So if you can reduce your overhead in interacting with a customer, you may be able to deliver a better service to that customer, deliver better service to the other customers who are being impacted by those service drain customers. Now, we've already, as I said, put that into place with those initial customers. And what we've already seen and through tracking some results is actually an increase in profitability, a change in customer behavior, and a reduction in the cost to serve across the customer base. So we're seeing those business benefits. Now, the really nice thing about this is the model that we put into place, and also the data that's flowing into it is evolving. So as your customer base improves its performance, as the behavior changes, the model is analyzing that new data and pushing out new insights. So what you actually get is an ongoing ROI. So it's not just a one-off analysis of your customer base to see how they're performing. It's an ongoing review, and it's a self-correcting model. Okay, so that's what we put into place. That's what we've got available. Just an idea, and I understand and I appreciate that this probably isn't particularly easy to see, but this is the model that we came up with in terms of stratification. And I can actually zoom in, or should be able to zoom in here. So what we've got for each type of customer, for each area of interaction, we've got a series of drivers. So it could be number of product classes they buy from you. It could be the number of lines per invoice. It could be the mix of products that they take, whether that's equipment or supplies. It could be the cost to serve, so How quickly do they pay their invoices? How often do they return product? How much does it cost you to get the product to them, whether it's pick up or being delivered? How loyal is the customer? How long have they been with you? Okay. So all of those things go into this model. Now, this model allows us then to apply industry-specific or business-specific weighting. So if, for example, your business doesn't allow returns, or only ever does pickup, or only ever does a particular type of product, doesn't have an extensive product mix, we can change the weighting in this model to match your business. Okay. Now, what you end up with once you've run all of the data and applied all of the scoring and weighting within this model, what you end up with is a customer score. And depending on where that customer falls within that score, depends on whether they go into the core customer category, the opportunistic, the marginal, or the service stream. And once you know what category they fall into, you can then start to take some action off the back of it. Okay. So that's the model. So how do you use that model and the data that comes out of applying that model? How do we use that within a real life scenario? Well, let me just scroll down a bit further. And I'm here now looking. So all of everything we've seen so far, we're looking at something within Phocas. We're actually in a Phocas dashboard at the moment. And on this Phocas dashboard, I've got a series of customers. I can see the sales revenue, cost of goods sold. I can see the gross margin, dollars and percentage. So I can see which customers I'm interacting with, how much I'm doing. So this is a typical report, and something that's very easy, very simple to do in something like Phocas. Now I look down this list here, and I may have, for example, a call coming up with a customer. I may be going on site to visit one of my customers. Before I go there, I might want to do a quick review and see what how they're performing. Now, within Phocas, you have the ability to create and maintain what we call customer scorecards. Now, those customer scorecards may be looking at everything from accounts receivable outstanding to product trends to product mix and so on. And every customer that we work with typically looks to implement one of those. The standard Infor solutions come with those customer scorecards straight out of the box for you, but you can add to those and enhance those. So I'm going to go out and speak to these guys. I want to run a customer scorecard now, but this is going to be a customer profitability scorecard. So it's something specific to the functionality we just talked about now. So I'm going to click on this. And what it's doing is it's opening up that customer profitability scorecard, but it's only showing it for one customer. So just the customer I clicked on. So this is now showing me how this customer is behaving and performing. So I can see things like at the very top left, my sales year to date. So I can see how much we sold to them. I can see how much profit I made. So we made about $4,000 in profit. I can also see, though, that my cost to serve so far this year has been about $2,300, which means that my adjusted gross margin is under $2,000. So after applying cost to serve, I can see that my this customer isn't anywhere near as profitable as it was. So I started off with about a 14% gross margin. I ended up with a 6.5% gross margin. Okay. Now I can see here some sales trends. I can see a breakdown of how that cost to serve looked. So month by month, I can see that my warehouse storage expenses may change based upon perhaps the number of interactions, number of returns that we have, and so on. Now that's the customer I selected. What I can see down here is all my customers. So I can see actually how this customer compares to all my customers, and see that all my customers are doing about 19% gross margin and about 8.3% adjusted gross margin after we've applied that cost to serve. Okay. So being able to see how this customer behaves and performs in comparison to all of the customers gives you an idea of whether or not you need to try and change some behavior, whereabouts you can make some improvement. Now, I want to analyze this. I want to look into this a bit deeper. So what I can actually do, and as you can do with any Phocas dashboard or scorecard, I can drill into the detail that sits behind. So what I'm going to do is I'm going to dive into that 6.5%. I want to know what's going on here. So I'm going to click on Analyze, and it just drills in now into the underlying detail. So at this point, I've drilled in, and I can see month by month what my adjusted gross margin was for this customer. So I can see it fluctuates from month to month. We had a particularly bad February. At the moment, it's broken out here by the branch that this customer interacted with, and there's only one branch. But if they were taking products from various branches, we'd actually see a breakdown by branch. Okay. Now, that's just showing me that gross margin. It's not showing me any of the underlying supporting figures, but I want to see those. So what I'm going to do is I'm going to change my measures up here, and I'm going to bring in my sales dollars. I'm going to bring in my cost of goods sold. I'm going to bring in my gross margin dollars. I'm also going to bring in the gross margin dollars adjusted with cost to serve and that gross margin percentage. So I'm going to bring in all of those items now. What I've also got, though, here are a series of other measures. Each one of these relates to one of those derived or calculated cost to serve elements. So I'm actually going to bring those in as well. So I want to see how much I'm spending on AR, returns, deliveries, entertainment, and so on. So I'm bringing all those pieces of information in. Okay. Now I can see that complete breakdown for that customer. See where I'm spending all of my money. So I can see there's a big chunk of my profitability going in sales admin expense. Okay. So I can see that overall picture, which is really useful. What I actually want to do, though, is I want to see how that compares to other customers like the one we just looked at. So what I'm actually going to do is I'm going to come back and now look at my customer class. Okay, so this is the customer categorization that we have within my ERP. Okay, so I'm going to select that and focus in. So I'm now looking at just customers who are the same as this one. And I'm going to come back up to my customer dimension and remove my filter. And now what I can see are all the customers with the same type. So I'm now looking at a like for like, and I can see how that customer that we were looking at originally compares to everyone else. So I can see they're at 14% margin. Customers across the board in this category, 25%. The adjusted gross margin after is 11%. So this customer is not behaving the way we want it to. And we can, as I said, take a look now and see how the various cost to serve elements break down and compare. Okay. So seeing where your bleeding margin is useful, seeing where that's going. What you can then do, though, is start to take action and interact. So if you see a customer who is particularly costing you an awful lot in terms of accounts receivable, so they're not paying their bills on time, they're constantly taking as long as possible to pay. What you can do is either change the credit charges that you apply to them, so you can up the penalties for not paying on time, or you can change the terms that you offer them to rein that in a bit to get control of that. Likewise with if you're incurring a lot of return expenses, or if you're seeing an awful lot of expense from an order taking point of view, we're seeing lots of single line orders, you can offer incentives to consolidate orders during a day and change that customer behavior to drive up profitability. So that's one element, the customer profit side of things. We're looking at here broken out by customers, but do bear in mind that because it's an analysis tool, I can actually slice that by anything that's related to the customer as well. So I could potentially say which one of my sales reps is the most profitable, and truly the most profitable. So not profitable in terms of just gross margin, but profitable after we've taken into account cost to serve. So in this case, we can see that perhaps my top sales rep in terms of gross margin, 33%, is also my top one in terms of adjusted gross margin, but the others, not quite so consistent. Okay. So that's cost to serve. As we saw in the earlier slides, though, we're talking about profitability and categorization or stratification. So because we've got the ability to put all of our customers into buckets based upon the scores that they come out of that model with, I can now see a breakdown of my marginal, opportunistic, core, and service drain customers. So this is all of my sales revenue broken down by each one of those buckets. Now, I can see my core customers are giving me my largest gross margin and my best adjusted gross margin, exactly as we'd want to see it. I can definitely see, though, the issue with my service drain customers. They're taking low margin products from me in the first place, and then that margin is dropping even further in terms of cost to serve. So my interactions with them cost me even more money. So service drain customers, I can see what's going on. Now I've got marginal customers and opportunistic. Opportunistics may well be customers that are cherry picking product. They may well be people that buy an awful lot and send an awful lot back, order products from 3 different suppliers and then send back whatever gets there last. So opportunistic customers, I may want to manage those and try and turn those opportunistic into marginal, and work with these marginal customers where perhaps they're buying not quite the right product mix from me, try and work with them and move them into core. Okay. So having them categorized is the first part, then saying, let me focus in, for example, on the service drain customers. I can come back now and look at all my service drain customers. And this is now a hit list for my sales reps, sales team to go through and speak to and work with them and understand, well, you may be a large revenue customer, $400,000 in revenue, but we're only making 4%, $4,000 off you, off that 400,000, making 1%. No, almost no benefit to the business in terms of doing that, to working with this customer. So change that behavior, change the behavior of that customer to make them more profitable. Here we're seeing customers who are actually adjusted gross margin, we're making a loss. Change their behavior or stop doing business with them, because there's no benefit. There's a negative impact to the business to interact with them. Okay. So being able to identify, first of all, who is profitable and not profitable, who is interacting with you in a way you want versus a way you don't want, identifying them is first of all useful, but second of all, you can take action on it. Once you've taken action on it, you change behavior and drive up profitability across the board. Okay. So taking all of that information, taking the whole of that model, taking the whole of that process and working with it, dead simple within Phocas. Very easy for sales reps, sales managers to take control of this part of the process. Now, one of the things that we have done with those initial customers that we've implemented this with is we've started to track not just the transactional data here, so looking at who's buying, who's spending, what profit we're making, and so on. We're also taking snapshots of the customer stratification. So we're looking at each customer, we're looking at which one of these buckets they fall into on any given date. We're taking snapshots, and then we're looking at the change across the customer base. So you can actually start to track not just has my profitability improved over a period of time, but also have I managed to change behavior? Have we changed the way this customer behaves, and have they moved from one of my stratification codes to another? And again, we've been doing this with those initial customers, those core customers we first worked with. We've done this, and we've actually seen improvement. We've seen changes in the mix of their customer base for the better. So we've seen a decline in the number of customers that are service drain, and we've seen an increase in the number of customers that are core. So it's demonstrably beneficial to a business. As I said and we showed earlier on, it's an ongoing process. It continues to self-regulate and improve as the data flowing into it changes. Okay. So that's customer profitability and stratification within Phocas. I'm going to hand it back across now to Jenny Kate, just to kind of finish up and then potentially go to Q&A if there are any questions.
Thanks, Jason.
Now is a good time. Sorry, Jenny Kate, didn't mean to interrupt, but I was just going to say now's a good time to enter your questions or raise your hand if you do have one.
Perfect. Thanks, Gary. Now that we've seen how customer stratification works firsthand, we do want to share a couple of quotes from one of our customers that uses this functionality. Riley Sales, a Phocas customer and Infor user, says, Phocas helped us to develop a grading process that makes it easy to identify sales and customer engagement opportunities. Additionally, they noted that when they put up the sales numbers, the team members that use Phocas for analytics and reporting outpace those that don't. And now we're going to take some of your questions. I know as Jason was showing us Phocas and customer stratification, a few questions did come in. So we'll take a look. The first question, Jason, do we have control over the calculations in the cost to serve model?
Yeah, that's a good question. So that model, I know it wasn't particularly clear, the kind of the red, yellow, green kind of stratification model. That's where you would have some control. So in terms of changing the weighting, changing how important a particular calculation is to you. So for example, if all of your sales are cash only or COD, the accounts receivable cost to serve might not be important to you. Or if you don't allow people to return products, or if you charge them a restocking fee, so as a result it's a net, it's a wash in terms of profitability, you might want to lower the weighting on that. So absolutely you can do that, but also you could potentially bring in other things. So if there are other parts, so what we've got there are the kind of the core expense types that those initial customers told us were material in terms of managing profitability in their business. But if there are other ones that are specific to your industry, to your business, then sure, I'm sure we can definitely expand on this. I mean, that's one of the things that we're keen is that this, with every customer, even ones that are happy with those initial set of drivers, we're going to continue to work with our customers. So it's an ongoing process. So every year we'll have a review with the customer, and what we're actually going to do is tweak and change that model, maybe add some more drivers if those are required.
Okay, great. Another question that came in, do we have control over the calculations? And oh, I'm sorry, I already read that one. Sorry about that. Rebates are important to our profitability. Can this be factored in?
So I'm not sure if this is relating to rebates to your customers or rebates from your supplier. But the bottom line is yes, either one can be taken into account. So whether it's a rebate that's being paid to your customer, if that eats into profitability and isn't necessarily recorded at the transaction level in your ERP, then yes, we can. If we got an algorithm or a methodology for calculating that can be factored in. Phocas does actually have a rebates tool. So for companies where you're not capturing the rebate against the invoice or in the ERP, but you're doing, some customers will be managing that manually in an Excel spreadsheet. Phocas actually has a rebates tool that allows you to plug in all your rebate rules, push the transactions through, and then they end up with a bunch of transactional information that tells you how much of a rebate should be applied across the board for each transaction. So we can use that as a driver for the customer profitability as well, for sure. And if it's already going straight into your ERP and it's just it's already being recorded against the invoice, then we can bring that in as well.
Okay, great. Looks like we have one more question. Does it matter what ERP we are on?
No, it doesn't. I mean, if somebody's already a Phocas customer, then that the data that we're going to be using will almost certainly already be flowing in anyway. So we're already pulling the sales transactions and so on in. So for anyone that's an existing Phocas customer, it makes no difference. But no, it doesn't matter. The data source is almost it doesn't care. The model is applied to the Phocas database, Phocas analysis databases. So where that Phocas analysis database is being populated from doesn't really matter. So it can be any of the Infor products. We've worked with some companies over the years that are running multiple ERPs. So they might be running an Infor product and a non-Infor product. We can bring both of those together, merge them, and then pull that into the profitability model. So no, it doesn't make any difference.
Great, thanks, Jason. So this brings us to the conclusion of the webinar. If you'd like to learn more,
Jenny, Kate,
or if you have,
Jenny,
yeah,
Jenny, Kate, I see three more questions out there. Kind of curious. Let me read these three questions as well. Okay.
Yeah, go ahead.
Is it possible for all customers to migrate to Core?
Would it be possible for all customers to migrate to Core? That's a good question. So I think not, essentially, because what we're looking, the way the model works is it looks at the average, so the average performance of all of your customers. So that's one of the things that kind of makes it continually evolving. The bar basically gets higher. So as your customers behave better, it's harder for a customer to qualify as Core because the average. So no, it looks at the average. It looks at deviation from the average. So not everybody would be Core, for sure.
Okay. You know what? John Mansfield asked the remaining two questions as well. And he raised his hand. So I'm going to unmute you, John, and maybe you can just have a conversation here. So John, you're unmuted. You can ask the other questions.
Hi, John.
How often do you re-stratify each customer's?
So the algorithm runs. The algorithms run every night. So every time we pull new data into Phocas, the algorithm gets run again. Now, in reality, because of the way all the calculations and the weighting are applied, it's unlikely that a customer would change stratification from day to day. So it would need a continued change in behavior to move them from one to the other, and it would take it. So it would be a kind of a curve rather than a step change to move from one to the other. So it would be an arc. But yeah, the algorithms are applied every night, which is why over a period of time with the existing customers, we've seen so for example, they'll start with 150 customers that are Core and ended up with 170 that are Core because they managed to move some of the marginal ones into Core. So it changes over time, but it's not step change. A customer goes from one to the other back again day to day to day. It's a smoother curve than that.
And the other question I had was whether most of your users are managers or salespeople or both.
So for the customer profitability, on the customer profitability side, for sure, you probably see more managers initially using this. What they may end up doing though is giving visibility. So the kind of the top level analysis of what's going on and how the customer base is changing and so on. That would definitely be kind of more management side of things. But in terms of getting the data in front of people so that they can see it and maybe take some action on it. So making sales reps aware of how profitable their customers are. That's something that absolutely sales reps will be using. And the regular Phocas product, I would say the places where we get the most, companies get the most benefit is when they're getting the data into the hands of as many people as possible. So yeah, getting it into the hands of salespeople, product managers, controllers within the business. That's where you get the most benefit because it's those are quite often the people that don't have the skills or the access into the ERP to be able to run the reports in the first place.
Thank you.
No problem. My pleasure.
Okay, now I don't see any more questions.
Okay. Thanks so much, and thanks, Jason, for answering those questions. It's great information. If you do want to learn any more, you can contact us via this information, and we'd be happy to schedule a personalized demonstration for your business as well. So thanks, everyone, for joining, and thank you, TUG, for hosting us today. You can now disconnect, and we hope you enjoy the rest of your day.
Thank you.
Thank you all.
Thanks, Gary.